Welcome to The Explainer. Today, we're going to pull back the curtain on one of the biggest mysteries in the financial world. A process that can seem kind of like a dark art, but really, it's a disciplined craft. We're talking about professional valuation, right? This is the fundamental question. Let's just forget the stock price bouncing around every single day. How do the pros, the serious analysts, the big-time investors figure out what a business is truly, fundamentally worth? So, how do they do it? Let's dive in. To see why this is so tricky, just look at this quick example. If you only use one popular metric, the price-to-book ratio, you might look at a software company with almost no physical assets and think, well, this is worthless. And then you look at a bank full of assets and think it's incredibly valuable. This is such a classic trap, and it shows why a single number isn't just incomplete, it's actually dangerous. So, in this explainer, we're going to go on a little 5-part quest. First, we'll get to grips with that single method trap. Then, we'll unpack the professionals' toolkit. We'll see how they plan for a future that's always uncertain, how they triangulate a final value, and then we'll wrap up with the absolutely crucial analyst's mindset. Okay, so we just saw how one little metric can totally mislead you. That's exactly what we call the single method trap. Let's really hammer this point home, because relying on just one number, well, it can lead you completely astray. The pros, you see, they have a totally different perspective. When their different methods give them different values, they don't see it as an error. No, they see it as a clue. It's the data telling you, hey, this company's worth isn't one-dimensional. And that makes perfect sense, right? A company's value comes from so many different places at once. It's about its power to make money, sure, but it's also about the stuff it owns, its potential to grow, and even those intangible things like its brand and how dominant it is in the market. There's just no way a single metric can capture all of that. So if one tool isn't going to cut it, what does the professional's toolkit actually look like? Well, let's unpack the 4 essential valuation ratios and think of each one as just a specific, powerful question an analyst is trying to answer. First up, the most famous tool of all, the price-to-earnings, or PE ratio. This is really the workhorse of valuation, and it compares a company's stock price to its recent profits. To put it simply, the PE ratio asks a very direct question. If a company has a PE of, say, 20, it just means investors are willing to pay $20 for every single dollar of its annual earnings. It's a straight-up measure of market confidence. But, and this is a huge but, a PE ratio is totally meaningless in a vacuum. Context is everything. What's a good PE is completely different depending on the industry. A stable IT services company might trade at 20 to 25 times its earnings. Meanwhile, a consumer goods company with really powerful brands might command a much, much higher multiple, maybe 35 to 50 times. All right, let's move to our second tool, the price-to-sales ratio. This is the one you pull out when a company doesn't have stable profits yet. Think of a high-growth startup that's pouring every penny it makes right back into the business. The question here is all about the top line, the revenue. The PS ratio tells you how much the market is willing to pay for every dollar of a company's sales. It's incredibly handy for valuing those fast-growing tech companies or even cyclical businesses where profits might be down for a bit. Our third tool is the price-to-book ratio. And this brings us full circle right back to our opening example. This one compares the company's market price to its book value, which is just the net value of its assets sitting on the balance sheet. This ratio is all about tangible worth. It asks, what are you paying for the company's net assets? The stuff you could, in theory, sell off tomorrow. And this is exactly why it's so important for banks, manufacturing companies, and real estate businesses. Okay, finally, we have what a lot of pros consider the heavyweight champ, the EV to EBITDA ratio. Now, don't let the alphabet soup scare you. EV is enterprise value. Just think of it as the total price tag to buy the entire company, debt and all. And EBITDA is a way to look at a company's cash flow from its operations before you factor in stuff like interest and taxes. Comparing the two gives you this really clean picture of a company's value, which is fantastic for comparing businesses that have different amounts of debt. Okay, so we've got our toolkit of ratios, but here's the catch. All of these tools rely on numbers that are basically just guesses about the future.
And let's be honest, the future is always uncertain. So how do the pros deal with that? Well, they stop trying to find one single right number, and instead they build a framework for a whole range of possibilities. They do this using a really simple but incredibly powerful three-scenario framework. They'll model a conservative or a downside case, what happens if things go wrong, then a base case, what's most likely to happen, and finally, an aggressive or upside case. Then, and this is the crucial part, they assign probabilities to each one. And here's how that whole framework actually translates into a solid number. Let's take an example, like the IT company TCS. An analyst figures out a target price for each of those three scenarios. Then they multiply each price by its probability, 25%, 50%, 25%, and just add them up. The result is a single probability-weighted target. See? It's not just a guess anymore. It's a calculated expectation.
So now we've got multiple tools and we've got multiple future scenarios. The last step in the calculation is bringing it all together. How do you combine all of this stuff into one single cohesive answer? This is where the real art of triangulation comes in. Okay, this right here, this is the real secret sauce of professional valuation. They don't treat every tool equally. Nope. Instead, they give different weights to each method based on the kind of company it is. For a bank, that asset-focused P/B ratio gets a huge 50% weight. But for a high-growth tech company, the future-focused PS and EV/EBITDA ratios get most of the attention. It just makes sense.
Here's what that looks like in the real world for a company like Asian Paints, a mature consumer goods business. The stable, earnings-focused PE ratio gets the highest weight at 40%, while the other metrics all contribute to kind of round out the picture. This creates a balanced, robust final number that isn't just relying on any one single assumption. So we've triangulated a fair value. We have our number. But is the work done? Not even close. The final, and maybe the most important step, is all about mindset. It's about protecting yourself against the one thing we know for sure, that our perfectly calculated number is almost certainly going to be a little bit wrong. And this is the professional's ultimate protection, the margin of safety. After all that work to calculate a fair value, they will only invest if they can buy at a significant discount to that value. This buffer, usually 20% or even more, is what protects them from bad luck, from market panic, and from their own inevitable mistakes. You know, when you pull it all together, you realize that professional valuation isn't about finding some single magical number. It's a system. It's a process of asking better and better questions. You use a full toolkit, not just one screwdriver. You plan for a whole range of futures, not just the one you hope for. And you demand a margin of safety because you have the humility to know you'll never be perfect. The goal isn't about being right, it's about being prepared. So now that you have the framework, what questions will you ask next?